Welcome everybody. This is the new episode of Market Focus. I'm Fabio Petti, Deputy Head of Group Investment Strategy. I'm here with Marco Valli, our Chief Economist, and Alessandro Caviglia, our Chief Investment Officer for Italy. We just closed the Group Investment Committee, where we basically discussed, Marco, about the diverging path that we expect on the two sides of the Atlantic Ocean. On one side, Europe, with a modest growth, but on the other hand, slowing inflation. On the other hand, on the US economy, stronger, at least above potential, but with some inflation risk. Will you give us some more color about the kind of trend?
Yes, Fabio. So in the US, we think growth will remain solid, both this year and the next, probably just above 2% in both years, so that is above potential, right? We think fundamentals are in good shape. Households and the companies' balance sheets are actually in a good shape. And we also think that the combination of Trump policies, particularly when it comes to fiscal stimulus and when it comes to deregulation, will be able to support economic activity, while tariffs and tighter immigration rules actually will be posing a drag on growth. But overall, the mix of the policy, I think, will be broadly supportive for activity and will keep economic growth above trend. But this combination and set of policies has also inflationary impact, right? Because higher tariffs will raise import prices. Tighter immigration rules will basically create friction between demand and supply for labor, while at the same time, obviously, fiscal stimulus will be supportive for economic activity and therefore potentially inflationary. So this means that in our forecast, inflation will fail to adjust down to 2% and to the Fed's target, with obviously important implications when it comes to the trajectory of monetary policy. Moving to the Eurozone, the situation is very different because we start with momentum in the economy, which is actually quite weak, right? Growth broadly stagnated at the end of last year. The latest indications do not suggest that we are recovering to any meaningful extent. So we think that in the short term, momentum will remain weak. At the same time, Europe will have to face potentially rising trade tensions, the threat of tariffs, and this is going to be particularly negative for an economy which tends to be largely skewed towards the manufacturing sector, right? So in the past, typically external trade was always a tailwind when it comes to recovery momentum. This time around, the external environment for the euro area is going to be quite challenging. And this happens at a time when CapEx plans are quite weak, due also to the high uncertainty, and the labor market is deteriorating, right? So this leaves us in a scenario where economic activity is going to expand by below 1% this year, just above 1% in 26. So overall, we will remain below trend. Implication for inflation, I think we can remain constructive on the disinflation process here in the Eurozone. We still miss the final leg of disinflation coming from services, but I have a high conviction that this is just a matter of time. And when also services inflation will start slowing more decisively, all the conditions will be there, I think, to achieve a sustainable convergence of inflation towards the ECB target.
So you mentioned the ECB. What then to expect on one side from the ECB? What kind of pattern you see from now till the year end? And on the other side of the ocean, what to expect from the Federal Reserve?
The ECB has to deal with an inflation picture which I think is moving in the right direction, and weak growth with potentially intensifying downside risks, right? Including for the labor market, which so far has been quite resilient, but seems to be weakening now. So this, to me, has a very clear implication, and that is the ECB will have to continue to cut interest rates, right? Currently, we are at 2.75%. I think we still have another 100 basis points of cuts to go. I think terminal rate will be 1.75% by the end of the year, as in my forecast, the downside risk to economic activity prevail over upside risks to inflation. Very different the situation in the US, and for the Fed, as I mentioned, above potential growth and sticky inflation is definitely going to require monetary policy to remain in restrictive territory. How restrictive? That is obviously a very important question. In our baseline scenario, we think that there is scope for the Fed to cut another couple of times. So from 4.50 currently going down to 4% in the second half of the year and stop there. So still restrictive. But the risks are clearly tilted to the upside. So it's quite possible that the Fed will not be in a position to deliver any further rate cut from current levels.
So Alessandro, on the back of the scenario that Marco just depicted, no, with a different converging path between the two sides of the ocean, but yet in a global economy that is expected to grow 3.2% for the year to come, what is the investment strategy that you're following? What kind of advisory we can give to our clients?
Yeah, sure. I would focus on the two main aspects of the scenario depicted by Marco. So the weakness point, the strength point. Weakness is clear. We are referring to the European economy. European Central Bank will cut rates. And so basically we will have a solid environment for the fixed income investments, euro denominated. The more the ECB will cut rates, the lower the potential return of the fixed income portfolios. That's why we are building what we call quality carry positions. Basically, we will allocate a core component of our fixed income portfolios to corporate investment grade. We have a spread, we have a very well diversified portfolios, and as satellite positions, emerging market debt, where we can capture the yield from the treasury curve, which is higher than the European ones, and the spread from the issuer countries, which currently have an average rating quite high, around BBB, so more or less investment grade. On the other side, when we talk about strength, we have to acknowledge that the US economy is accelerating, and so the equity environment is a friendly one. Particularly the way we build portfolio is a global approach we have, and we have a preference relative for US against Europe. That said, probably this year will not so easy, let's say, or will not have a linear upward movement as it was in 2024. Probably we will have much more, let's say, negative temporary phases. We could call them air vacuums. But basically, we could also profit from this movement to gradually accumulate on an equity position. But overall, we think it's a good environment also for equity markets. Basically, we have expansionary fiscal policy in the US, accommodative monetary policy in Europe, and also we have a good environment for companies, as last earnings season has showed us.
Very good. So basically, maybe a less linear trajectory versus what we saw in 2024, but with some good result. And this, I think, is also proven by the result we got year to date on our portfolios in 2025. Marco, you mentioned about below potential growth in Europe. There are two important items in the agenda in these very weeks. One is the German election that has been just held on Sunday last week. And the other one is the discussion around the need for increasing the expenditure on defense on the Eurozone and in UK. What shall we expect on this very important item from a structural standpoint? Can they somehow be a silver lining in the narrative for the Euro growth?
I think in Germany, fiscal policy will become more stimulative. Although it's tricky and probably the boost will not be large. Let me try to explain this. In the new parliamentary configuration, basically mainstream parties do not have a two-thirds majority, which would be needed to amend the debt brake. Okay, so this is going to complicate life for the new Chancellor Merz. And this also explains why there is currently a push to try with the outgoing parliament, right, to pass a large package for defense spending before the new parliament sets in. Because in the new parliament, basically, the left will be against reforming the debt brake to allow for higher military expenditure. So there are currently attempts to bring forward this increase in public spending at the approval of the defense package now, because the current parliamentary confirmation allows you to do this, because mainstream parties do have the 2/3 majority. And once the defense topic is, in a way, out of the table, you maybe can find the majority, with including the left, to amend the debt brake and support more fiscal expansion to finance infrastructure investment, digital and green transition. At the European level, I think that the US withdrawing basically from the role of guarantor of security globally, weakening NATO, does require a meaningful step up in defense spending. Okay? How to do this? Both at the national and supranational level. National level, von der Leyen has already announced that there will be a proposal to trigger, to activate an escape clause to allow member countries to increase defense spending while remaining compliant with the budgetary rules. But we also need a response at the European level, right? Whether this is financed through the EU budget or through the issuance common debt, it doesn't really matter. But it's important that there will be also the supranational level, because that is going to be critical when it comes to investors' confidence in Europe.
I think that this can definitely be a game changer for the Eurozone. Alessandro, Marco mentioned potential implication on some of our key sectors for the European economy. So given all the uncertainties, but also the opportunity that we just mentioned in our Group Investment Committee, what is our stance for the Europe and the US in terms of sector? Which sector are you suggesting now?
Okay, well, starting from Europe, I would say financial, healthcare, industrial. Financial, as a first step, they have strengthened a lot their capital. So today they are much more solid. And then they are working on the business model to increase the contribution from the margin from services, so they can perform well also in an environment with declining rates as we are as of today. Healthcare, we have very interesting companies, themes that in a certain way have a really huge growth potential and somewhat are also related to the incoming technological revolution. And coming to industrial, Marco was mentioning the challenges, the strategic challenges Europe is going to face. Basically, we will have to lower our dependence from foreign countries with respect to defense, IT, security, energy. In a sense, we have to reindustrialize our economic tissue. That's why we think that industrial can perform quite well in the current environment. Coming to the US, we think that the technological sector in the broad sense is still key. We acknowledge there is an issue with regard to concentration, to valuation, and basically the undisputed lonely leaders of today, the mega cap, probably in the future will face more competition. So what we are trying to do is to build a portfolio within the portfolio, trying to understand also who will be the winner of tomorrow. We complement these positions with what we think it's the prerequisite for the technological revolution, which is basically the transition, the energy transition. So we invest also in the utilities sector, in the infrastructure sectors. Financials also in the US can perform well because basically they will work in an environment with higher rates than expected. And we have also to consider that the deregulation promised by the new administration can support. And finally, we are also building positions outside, let's say, the large cap, the mega cap market segment, within the medium capitalization segment, the mid-cap, because we think that the economic participation will increase since we are in an acceleration phase for the US economy.
Thank you so much, Alessandro. Very clear. Thank you, Marco. And thank you for listening. See you on the next one.